That takes us to our talk of the tape. Can it stay this easy for much longer? Let's ask Cameron Dawson, NewEdge Wealth Chief Investment Officer, and Virtus Investment Partners Joe Terranova, a CNBC contributor, of course. So, that kind of lays it out. I mean, if you were just looking, Cameron, at the behavior of the market, it got overbought and it's staying that way. That's usually a sign of a pretty durable rally. You're seeing this broadening action that we saw. And then with stocks at record highs, credit spreads tight, the economy looking okay, you have the Fed not doing anything to say, stop thinking about rate cuts. So I think it's one of those situations where, is the only bear case that there's no bear case?
Yeah, probably. I mean, right now, growth and the Fed aren't giving the market any reason to pause this momentum. If those things were to change, yeah, maybe you would see some digestion. But to your point, you're still seeing this chase into the market. And something that we're watching closely because positioning is extended, but not at extremes, which just means that dips are getting bought and you still have the chase to get people invested. Eventually, everybody will be on the same side of the boat, and that's where we'll really have to watch positioning, sentiment, valuations all be extended. For sure. And even this little one-day pullback, Joe, that we got, it was just one day. And this has been the pattern for a while right now. We had 1% down on Tuesday. It got picked up, and so the dip buyers are getting rewarded immediately. So that's just self-reinforcing here. And it reminds me a bit of the beginnings of 2013, 2017. And that was where you had this acceptance of the bullish consensus about the economy and about the markets. 2013, you broke to your first record high in 13 years. 2017, it was going to be tax cuts and a revitalization of the economy. And then the market kept going, even though it felt like it had to pull back. So that's not a prediction, but that's an observation.
Well, it's also, remember, what set the stage for all of this was a reversal in fundamentals.
Sure.
Coming into 2023, you were in the middle of an earnings recession. You carried that into the fall for the S&P 500. You had an adversarial Federal Reserve that really didn't step back from the disposition until December. So that set the foundation for an environment which overwhelmingly bearish sentiment was still dictating that positions sit in those cash yielding equivalents. And what you foster from that is a very strong technical rally. And I think it's important to understand a lot of times when you break out from a significant high, and the January 22 high was significant, not so much in terms of price, but in terms of the duration in which you didn't revisit it once again, nearly 2 years. Once you break out for that, the bearish argument is, well, you'll potentially get a failed breakout. This was the complete opposite of that. You're 6% above that breakout high. This is a powerful, momentum-driven rally. And right now, what that suggests is you just want to continue to buy high, sell higher, own the winners.
Well, yeah, that's been the game. And I guess, Cameron, the things that really do give you pause, if you just look at the broad setup of fundamentals, technicals, everything, are the things that aren't very good at timing the market, right? So it's valuation, the backdrop. It's hard to slice it in any way that says that valuations aren't full or worse. And then, you mentioned the positioning and sentiment stuff. So I'm looking at the retail investor survey, the investors intelligence work, and it's all right up flashing in that upper end of the range where you're starting to get excessive readings. On the other hand, if you look at prior bull markets, they can stay there for a really long time. It's not a moment of a top. It's a process. Exactly.
And I think the notion is that complacency needs a catalyst. For those things to become an issue for the markets, for stretch valuations, stress positioning, and as well as stress sentiment to become a problem, you have to have something that causes people to de-risk. That could be growth estimates coming in, but at this point, we're not seeing any real reason as to why we should be cutting GDP estimates at this time. We see a recovery in some cyclical areas. We see the consumer remaining strong. So growth estimates still might have some upside, which means that until we get them to turn over, then valuation, sentiment, and positioning become just poor timing tools.
Sure. And yeah, Joe.
No, that's such a great point. There has to be an exogenous shock at this point in this breakout of the trend. And I don't think it comes from the economic data. I think we know. I actually think right now, sitting there being the Monday morning armchair economist is going to hurt you. You have a disinflationary trend in place. We know that growth is good right now. And the Federal Reserve and the ECB and the central banks are looking to begin a rate cutting cycle. So don't focus so much on the economics. I think what reverses this strong momentum, to Cameron's point, is something that we don't know, that is the exogenous shock.
Exactly. And so therefore, it kind of doesn't pay to try and figure out what that shock might be, except you can know that the risk reward is not great if this is like the beginning point for new positions.
Okay, but the insurance on that is incredibly cheap. You know, you've got a VIX below 15, so you could buy the insurance if you need it.
And you gotta, you have to be the type of person who's willing to let the market have some fun without you. If you are one of those.